Tim Quast, founder and CEO of Market Structure Edge. There he is from. Is he outside?
I'm calling golf course.
There is a golf course behind me. Yeah, I am.
Yeah.
I am.
What hole is that behind you?
Say again.
What hole? What hole number is that?
Is
that the 18th?
No, I think it's the 11th. I can't remember because I don't play that course. It's
it's behind you. You don't
should
play
be.
it?
Right. I walk around on it with the dog, and there are a bunch of deer
Your
on
dog
it.
poops on our golf course.
but I am.
This guy has more houses.
If I was golfing, you would on that hole. You would not be sitting there. You would not be safe.
I'm yelling 4 all day long.
Yeah, I mean,
4.
We do have a wall here, Joel, that we can dive behind when you're at the tee. So that's why we've got that. It's as Lucas Nelson would say, this is just outside of Austin, which is a great song by Willie Nelson's son. But hello and happy Monday to you guys. Good to see you.
Tim, last week was crucial. We were talking to you on Monday, and you said, wait, I think you said was it Tuesday or Wednesday that you were keying in on? Wednesday, right?
So we said that Monday when new options traded, Monday the 20th, which we'd said that for a couple of weeks, would be the most important day for traders in September. And of course, it was a very difficult day. Then the market bounced back, and now where are we? These are but it's again, I think, a great reminder to traders who listen to this program that there is clearly a connection between options expirations and volatility in the markets, and what
100%.
tends to happen. Yeah, there's no question about it. I tell folks all the time that headlines don't explain volatility. Headlines are a consequence of volatility, because what happens is that most market observers then cast about for a reason to explain why the market did what it did. So then we're all concerned about it's China, it's Evergrande, it's this thing, it's that thing, it's the Fed tapering. And then the next day the market goes up 600 points and no one knows what to say. I put this in the market desk note to edge users this morning that there were on the same day in the Wall Street Journal. The top headline was Evergrande worries hit markets, and then right below that was Dow rebounds to positive performance. That was the best they could come up with, because what do you say? What's the explanation if in the same edition of the Wall Street Journal you have an article about why the market is crumbling on Evergrande and then it's up, right? So that was on Tuesday morning. And it's important to understand, I think. And you may have been
exactly
talking
right.
about this.
I mean, the media always wants a fundamental reason for why the market did what it did, when a lot of times there is no fundamental reason, and they do search around and they do call around, like, what's going on? Why are we selling off? You give them some technical reason, they hang up the phone and call the next person, because they don't want to write up some technical reason. They don't want to write up something. Well, you had all the options expire on Friday. Now it's opened up a little bit because you don't have all those people who are owning the calls and the puts as natural buyers and sellers. So you lose all that liquidity and it opens itself up. But they don't want to hear that. They don't want to hear the technical reasons that Tim Quast is going to give you today. They want to hear Evergrande is blowing up, because that's a sexy story.
You're exactly right. You're in that chair. I interact with reporters all the time, and I will say, well, this is the reason. And you're exactly right. That's not an interesting story to say, well, 20% of the market rests on derivatives, and if that level, if the demand declines into quad witching, well, it's very likely the market's going to go down. Well, you write that in a story and nobody reads it. It's just so much more gripping to talk about $300 billion dollars of debt hanging over Evergrande. I get that, but that doesn't mean it's correct. It's and what we want as traders is to know what's coming. We want to know what the risks are so that we can avoid them. I love to say, with Market Structure Edge, take gains, not chances, because any gain is better than a chance that leaves you holding an empty bag. And so we want to know what's coming, and then how do we know? Well, month end, and in this case, quarter end too. Month end and quarter end window dressing. It's very important to understand this. And once again, the media tend to gloss over this and ignore it. And it's very important. And it gets back to understanding the motivation of money. So, and there are effectively 3 different motivations. If you're hedge funds who are trying to improve performance before the month ends because you let your customers know, hedge funds tell their customers monthly how we're doing. And they're measured internally monthly. They're very concerned about those sorts of things. So in the last week before the quarter or the month ends, you're going to see a flood of effort to try to improve returns. And what did we get? A very nice performance in the market. That's one thing. Then passive money tends to be the exact opposite of that. If there is volatility, all of the people, including me, who have managed accounts, who want to control volatility, their advisors are going to talk to them and say, hey, we may be hitting the period of bumpiness in equities. What do you want to do? And there'll be adjustments made. And what tends to happen is that passive money reduces its exposure in the face of volatility. Plus, it causes tracking errors. Again, it's very important to understand that BlackRock's indexed funds aren't trying to outperform the benchmark. They need to track it. All right, that's all they want to do. And so if that becomes more difficult into the end of the month, or into the end of the quarter, they're going to reduce their exposure to anything that it contains volatility. I'm telling you, that's what's going to happen. So it's important to understand why. Well, there's a T+2 window. It used to be T+3. Well, tomorrow is T+2 to the end of the quarter and end of the month. And if you want to have everything done, if you've got a lot of money to move, that's when you're going to begin, because you've got to be finished. You don't want something hanging out over the end of the quarter and the end of the month that might come back to bite you.
Good point.
So that's what's going to happen. So what does that mean for the markets? Well, I've been saying since a long way back, but let's just go back to September options expirations a week ago, because thinking, as George Santayana said, who was really, what was it? Jorge Agustin Nicolas Ruiz de Santayana y Boras. That is George Santayana.
For sure.
Yeah, George
And
Santayana.
I'd hate to write that on my school paper.
Okay. So he was, he's a philosopher, but he wrote in 1905 in Great Ideas of Western Man that those who cannot remember history are condemned to repeat it. So you're lucky, traders, that we're only thinking about a week or 2 or 3 or 4, because that's how we think. All right. So what we want to be aware of is, what was the money doing? Well, I think the money told us, and we've been writing about this, that it's shifting away from things that have more risk into things that have less risk. We've talked for 9 months about the great rotation to value, but it hasn't happened. And I don't know that it will happen, but I think the data are clearly telling us that tech is going to get more risky because it's more volatile, and things are going to shift to things to the kinds of exposure that offer less volatility. Good to know that in advance, traders. You have a short window. I would say you have 2 or 3 days at most to trade those tech things that you love. I sold my Fortinet on Friday. I mean, it's a great run. I got great gains out of that stock, and sentiment's still rising. It's a good thing to own. However, context matters. If I know that the money is beginning to be concerned about volatility, what will be impacted by that? Well, all the stuff we love: Fortinet, Palantir, Tesla, the FANGs, all that stuff will, and it'll be too late by the time it arrives. You want to be ahead of that, and that's how you avoid forgetting the history and repeating its mistakes.
But Tim, I just want to ask you about last week, because you did say you were keying on, and I'm pretty sure it was Wednesday was the day that you were going to key on as sort of like whatever happened Wednesday was going to determine your stance here for the near term. So,
right.
So knowing what happened throughout the back half of last week, I would take it that you're feeling pretty good here.
Well, yes and no. And I'll show you why. Let me just share, and we'll just hit high points today. We don't have to go through a bunch of tickers, but Edge Mob, you guys know this already. But I want to show you that this is what we look at, and I think it's important to understand why Wednesday was a good day, because we were fully out of the expirations period. It takes about 5 days. There's the Wednesday, Thursday, Friday of the preceding week where we have generally sometimes during the year, I think it's 3-4 times a year, it'll split into 2 weeks. But we had VIX expirations, index options expirations, and then quad witching. Right. Those were 15th, 16th, 17th. Then we have the weekend. Then the 20th were new options trading. We could already see declining demand for those. Well, then we fell off the cliff with new options. Then on Tuesday, we call that Counterparty Tuesday. It's the day every month when the banks will true up their positions. So once that gets sorted out, then Wednesday tends to be the reality. And markets took off. That's hedge funds saying, okay, we're in the clear. We're going to make a run at things. And if you're watching, that's what you want to capture. So that's what I did. So I have Wednesday, Thursday, Friday, pretty good days to trade. I had some broad exposure to the Dow, a little less to the NASDAQ, because that's where the money's going. The money's going into blue chips. But now I told traders, this is going to be a very short cycle. Because we've got hedge funds who maybe made up some ground with some heavy leverage, but we're going to have passive money turning cautious. So the month-end window dressing period could be bumpier than it normally is. That's my expectation, Spencer. I love that period. I wish it were longer, but you have to be nimble as traders. Take the data, what the data tell you, and do something with it. So here, I want to show you this. So on the right, this is broad market sentiment, the darker line, and this is SPY. So it's a short period here, just 30 days. But I want to show you that, this is options expirations, we got hammered. This is options expirations, we got hammered. And so if we're just a little ahead, we've been just a little bit ahead of sentiment each time, it tells me that we're getting closer and closer to trouble for the markets. And we've been talking about it before. I'm not saying, again, that the market's going to fall apart, but I do think those data have to tell us that we're running into trouble. So it makes me more cautious. It makes me say to myself, let's just reduce our exposure. Even though you would say, well, the sentiment's bottoming. Doesn't that indicate the beginning of a cycle? I think the cycle has already been speeded up because of quarter-end window dressing. And so be ready, traders. You just don't have much time here. Now, I can be wrong. Right? There's something could change the data. But when I look at that, how we've very quickly recovered when sentiment is lagging behind, and I know we've got quarter-end window dressing, I'm once again going to portage around risk. That's what I like to do.
Tim, we have the end of the quarter on Thursday, right? And I know there's some options expire with that. And then we have obviously the weekly options and the monthly options expiring on Friday. Is that what makes you think we're going to see a little bit of more volatility? I mean, when is the last time you've seen that, and what can you draw on from that past experience?
Yeah, so there's a huge futures contract that expires on the last trading day of each month. We've talked about this before. How the head of equities at Franklin Templeton told me, I wish the market for my passive money would be closed every day of the month except the last one, so I could true up all my tracking with futures and then avoid all the volatility that erodes how we track the broad measure. So that's important to know. And it was created in 2014. Now we're 7 years later, and the amount of assets in passively managed portfolios has exploded. So that's what happens. And it's again one of those situations. There are those you say, well, what do you do? Just avoid trading all month? No, not at all. But I'm careful around monthly expirations and month end. Monthly, month end, monthly, month end. That's how I think. And why? Because you can't see it. It's off the market, and we don't know the depth of that. We can get a pretty good idea by measuring the behavioral change heading into each thing, and it's one of the things we do. But we don't know precisely, and that's why, Joel. And here, what I've got on my screen, by the way. So I've got what I call my liquid up. It's a dynamic portfolio. It will tell me every day the stocks with rising sentiment that are very liquid, and those tend to be more conservative things. So that if you're gonna hit a period of volatility and you want to be in the market, then this is the stuff you want to look at. And right on my screen, from Cigna to T-Mobile. DocuSign is 54% short. That's too far for me. That's more than half of the trading volume is coming from borrowed stock. So there's your list. I mean, if there's any, and there's Fortinet. I was in Fortinet. I'm already out because it closed Friday at 311.90. It was actually 313. I bought it at 3, sold it at 313. Well, it's a very nice gain, right? So I'm out already, even though sentiment's still rising, because I've gotten my gain. But if you're going to find something that's more likely to be stable that might benefit from this shift that's occurring, that's probably it. I'm not promising it. I haven't gone through and profiled all of these things, which you can do. Just click the ticker and you could go look at it and see, well, what's the probability of a good return? But that's a good way to think about it, Joel, because this period, this is quarter end window dressing. And then you asked, when was it like this before? Well, I want to show you something because there is actually a precursor to this. So I'm here, this is version 2.0 of Edge, which we have now beta launched and we got folks testing it. I like to expand this back. Let's just go all the way back. There's a data set that you look at this and say, well, that's just a cardiogram for somebody who's eaten 3 cheeseburgers a day.
That's what it looks like. That's what it looks like. I'm not going to lie to you.
Yeah, right. Well, here's where we ran into a similar problem. All right, so see how sentiment got weaker and weaker and weaker, and then we fell apart in the fourth quarter of 2018. Okay, come over here. Weaker and weaker and weaker. I'm not saying that that's going to happen, but I'm saying I've been talking to the Edge users about the similarity between the fourth quarter of 2018 and the fourth quarter, which will begin Friday of 2021. Again, I'm not saying that that's going to happen, but when the data are similar, you want to know what history tells you. It's why I use that George Santayana quote. If we forget history, then we repeat its mistakes. And I know that weakening sentiment tells me money is less and less enthused about equities. And it doesn't give you a bunch of advantage and warning and time to make decisions. It will happen very, very slowly, then all at once. And we've actually been getting warnings since April that this is coming. And so all of that should feed. This is where the turn occurred. Up until April, we had a momentum market. And there's a carry-through effect. It doesn't just die. If you fire a gun, the bullet carries a long time, even though what caused that has ceased. Right? It carries for a long time. This is the same thing. All of that money we shoved into the market had a wonderful momentum effect, but it's dying. Okay, so then traders, we have to get more careful. I won't say cautious. You get more selective. You have to know where the money's going. You have to make sure that you're not buying stuff when sentiment's peaking, because that will put you at more risk. But that's what I would say, Joel. There is a similarity to 2018. And it's something we have to watch.
All right. If you want more of that, and arguably you need more than 10, 15 minutes to understand everything that Tim says, you can check out marketstructureedge.com. Tim joins us every Monday to give us his thoughts on the markets. Tim, thanks a lot, as always. Speak to you again next week.
Always a pleasure,
all right,
guys. Good to see you.